There have been many economic pundits predicting a massive market crash for at least 2 years now. In other words, inflation is staying way higher than the Federal Reserve's target of 2%, which means interest rates probably aren't going to come down back to where they used to be anytime soon. That's right. The CEO of JPMorgan is also pessimistic about the chances of a soft landing. There's actually a way for you to keep one toe dipped in the equity market while keeping your capital up to 100% protected. Sometimes investing can feel like walking a tightrope between risk and reward. On one side, high inflation is constantly eating away at your purchasing power. So you want to invest your money to outpace inflation and grow your retirement wealth. But if you lean over too far to the other side and take on too much of risk, then a sudden drop in the market could take out a big chunk of your savings. And if the fall is far enough, it could spell disaster for your retirement. So given all the drama in the markets over the last few years, everybody wants to know, is it safe to invest yet? Hi, I'm Khalid Shamim. I'm a wealth manager who works with expats in GCC, and in this video, I'm going to help answer one question. Will there be a market crash in 2024? We are going to mainly focus on the US market for two reasons. First, the US economy is not only the biggest in the world at 26.3% of the global gross domestic product, but it's also one of the few economies that are thriving right now. China still has an ongoing crisis caused by its property market, and Europe is struggling to grow at all. The US economy grew faster than any other big advanced economy last year by a wide margin and is on track to do so again in 2024. Second reason, whenever the US market falls, it tends to drag down the entire global equity market with it. We have seen this time and time again, and that's why you need to be aware of what is happening in the US even if you live half the world away. There have been many economic pundits predicting a massive market crash for at least 2 years now, if not longer. And last year, most people thought the US economy was headed for a recession, but it ended up never happening. Now, this year, investor confidence is back in a big way. Most investors are feeling pretty good about the economy, which is probably why many stock indices have been pushing new all-time highs in the past few months. We are only in August, and S&P 500 has already gone up by more than 15% since January 1st, and the Nasdaq is up even more at 17%. And it's not just stocks. You can see high investors' confidence in the bond market too by looking at the credit spread. This is where you compare the returns of safer government bonds to riskier corporate bonds. When the credit spread is tight, it means investors are putting more money into riskier corporate bonds, driving down the yields closer to the safer government bonds. Credit spreads have been steadily declining since a peak in 2020, which again shows investors are feeling very confident about the future right now. So, with all that being the case, why do so many big names on Wall Street all seem so wary of a market crash? First up, let's look at what the huge investing company Vanguard said in their market report for 2024. They publish one of these reports every year, and it's basically a forecast for what they think will probably happen over the next few years based on their highly advanced financial simulation models. Vanguard's main point in this report is that, quote, higher interest rates are here to stay. Central banks have, of course, raised interest rate in order to try to get inflation under control. And while some countries have seen some success in this, Vanguard points out that in the United States especially, a combination of factors has reduced the potency of monetary policy, allowing economic activity to remain resilient. For context, the year-over-year inflation rate for the US has stayed stubbornly high in recent months. In March, it was 3.5%, April 3.4%, and for May 3.3%. In other words, inflation is staying way higher than the Federal Reserve's target of 2%, which means interest rates probably aren't going to come down back to where they used to be anytime soon. And what would high interest rates mean for the stock market? Well, Vanguard come right out and say the US stocks are way overpriced right now. Or, as they put it, US equities prices exceed fair value. They expect the high interest rate to end the recent stock market enthusiasm and for investors to start looking elsewhere for less risky places to grow their money, like bonds. Probably the most interesting line in the report is this one on page 9, where they say, we believe a soft landing, where inflation returns sustainably to the Federal Reserve's target absent weakness in demand is unlikely. In other words, Vanguard is expecting a hard landing for the US, including a rapid pullback in the US stocks, which they believe are grossly overpriced. And Vanguard isn't alone in thinking investors are too optimistic. Back in April, the CEO of JPMorgan Chase, Dimon, released his annual letter to shareholders. And reading it, you might get a strange sense of deja vu, because he echoes almost the exact same worries that Vanguard did it in their report. Listen to this. There seems to be a large number of persistent inflationary pressures which may likely continue. Dimon also doesn't think inflation is going to go down as fast as most investors seem to think about it. And not only that, but he also said equity values by most measures are at high end of the valuation range. So again, Dimon agrees that the US stocks are overvalued right now. And why does he think investors are so bullish right now? Market seems to be pricing in a 70% to 80% chance of a soft landing. I believe the odds are a lot lower than that. That's right. The CEO of JPMorgan is also pessimistic about the chances of a soft landing. In fact, in a TV interview, he elaborated and said he thought the odds were about half of what the market had priced in. So only around a 35 to 40% chances of a soft landing. And then later in April, at an appearance at the Economic Club of New York, he said there was even a decent chance that the US could see a return to what happened during the 1970s with an extended period of stagflation. This is where there's a combination of both low growth and high inflation, which could be deadly for your wealth. But no matter what ends up happening, Dimon is confident that we are not going to be returning to another period of low interest rates that investors have enjoyed for the last 15 years or so, which could be a big problem for many companies. Rates have been extremely low for a long time, and it's hard to know how many investors and companies are truly prepared for a higher rate environment. In other words, he thinks businesses have gotten too comfortable with low interest rate, and those businesses could be in for a nasty shock when they find out that rates aren't going down as fast as they thought. It's like Warren Buffett said, only when the tide goes out do you discover who has been swimming naked. And speaking of Warren Buffett, it seems like he might also be someone who's expecting a market crash. To be clear, Buffett hasn't actually come out and said there will probably be a crash. Instead, you have to look at his behavior. Because the truth is, Warren Buffett hasn't found a lot to like in the stock market recently. In the last 6 quarters, Buffett has sold more stocks for Berkshire Hathaway than he bought. Earlier this year, he sold off a big chunk of his Apple stock as well as the entirety of his Paramount Global investment. So in total, he sold nearly 20 billion worth of stocks from Berkshire portfolios while buying less than 3 billion. Not only that, but right now, Berkshire Hathaway is sitting on a record-breaking amount of cash, $189 billion. Has Warren Buffett been quietly building up a war chest to prepare for a big market crash? I don't know, but it's a well-known that he likes to sweep in and buy when everything is on sale for cheap and everyone else is panicking. And Buffett isn't the only Wall Street veteran who's pessimistic about the short-term future of the market. Gary Schilling is considered a legendary market prophet partly because in January 2006, he wrote an article titled "The Housing Market Will Probably Burst." 2 years later, his prediction came true and he made a lot of money. Now, he is predicting there will be a recession by the end of 2024 that could cause stocks to drop by as much as 30%. And then he added that the decline, quote, could be even bigger than that. Schilling pointed out to the fact that for the past 7 recessions, they happened at an average of 26 months after the Fed began raising rates. It's now been over 2 years since the first rate increase in this cycle, which could mean the economy is due for a downturn. He also pointed out how there has been only one successful soft landing since World War II. And he concluded the odds are very much in favor of a recession. So there you have it. Vanguard, JPMorgan, Warren Buffett and Gary Schilling are all wary about the short-term future of the economy. Inflation is staying high, which means interest rates are staying high. US stock markets are overpriced and could see a hard correction sometime soon. Will that happen though? Honestly, I have no idea, and I don't really like to make predictions. Instead, I prefer to hedge my bets. So, let's talk about what you can do to keep your money safe if a market crash does happen. The first word you should always think of when it comes to managing risk is diversification. But obviously, holding lots of different stocks won't save you from a market-wide crash. Instead, you probably diversify into various different asset types that won't be as hard hit. And you have quite a few options. There's government bonds, money market funds, or a cash account. Even gold tends to do well during a downturn. But of course, with all these, you are paying the price for safety. Money market funds, for example, give you much smaller returns than equity markets do. Generally, when investing, you are paid a premium for putting your money at risk. And when you are not taking as much of a risk, like these options, you aren't handed so much of a reward. However, there's another option. There's actually a way for you to keep one toe dipped in the equity market while keeping your capital up to 100% protected. For decades, this type of investment was reserved only for the world's ultra wealthy because it required a buy-in of at least $1 million. It was basically an unfair investing advantage they held over the rest of us. But thanks to modern technology, bringing down that huge buy-in, regular retail investors like you and me can now take advantage of it too. It can let you reap the benefits of staying in the equity markets, but without the possibility of losing a huge chunk of your savings almost overnight. Anyway, if you want to learn more, simply follow this link in the video description below. I have been your host, Khalid Shamim, and thank you for watching this video. Subscribe if you have found it helpful, and I'll see you next time.